Next guest says the Fed has painted itself into a corner and it's too soon to say the central bank's December meeting will bring a cut or a hike. For more on the equity and fixed income markets, as markets await the Fed's policy meeting this week, we want to bring in Oksana Aronov, head of market strategy, fixed income at JPMorgan Asset Management at the table. Good morning.
Good morning.
So you're not sure whether you think there's a hike in store potentially?
So realistically, the bar for the Fed making a move either way is pretty high. And the bar for the Fed to hike here is pretty high as opposed to them staying put. But since they executed sort of transitory 2.0 late last year when they returned to this wishful thinking that inflation is moving down towards their target, I think they're now realizing that in reality, the R-star for this economy, sort of that neutral rate that is neither overly stimulative nor deflationary, is actually higher than something with a 2 handle on it and possibly has a 3 handle on it. And so I think they're kind of moving towards that realization. But ironically, for them to be able to cut, they need to be adamant about not cutting. And that's just not something they seem to be able to do.
Are you surprised there's not more volatility in the market, given that we're now at a point? It used to be that we were either on one path or the other. We thought they were either going to raise rates at a certain point, and then there was another point where we thought they were going to be cutting rates. Now, like you just said, we don't even know.
Well, they don't even know. That's the reality of it, right? They were so adamant about the fact that they were going to cut. We were looking at the data and saying, look, they've just taken all the fixed income returns from 2024 and pulled them into 2023, and that inflation is going to be stickier, and that's what we're seeing. But this entire sort of journey has shown us that they don't really know what they're going to do. And in terms of volatility, the equity market, I think, have tried to look past that somewhat, these rate expectations, although they're certainly to some extent baked into valuations. But I think they're looking past that and looking into earnings, which are continuing to beat. The bond market has had plenty of volatility, right? We're seeing significant moves, although I would point out that the volatility we're seeing in the bond market is very much on par with the vol levels we saw pre-2008.
The difference between 2 and 3 doesn't sound like much.
It is a very big difference.
It's huge. If you do it over 10 years and you look at buying power and what a dollar is worth, it's debilitating. What happened? Remember, Stiglitz was on last week arguing higher inflation is good. And what was the point that what we pay back is less in future dollars based on the debt service? I know, but that's a sick MMT way of looking at this. The difference between 2 and 3 is significant, and 3 is much worse.
It's significant, yes, because at the very least, our 10-year is still very much priced for a 2% world. And so I think even the market participants that are expecting cuts, and even if we were to get some cuts, in reality, that doesn't mean that the long end rallies from here, because the long end is still very much anchored to a 2% world.
What would the 10-year be if it was looking at 3%?
So if we think of the 10-year as really a compilation of growth, inflation, and some kind of a long-term premium, then the long-term premium, we can speculate what it is, but growth and inflation gets us to 5%, even with the weaker GDP number we got last week. Right? And our 10-year is not there yet. So I think the ramifications of moving from 2 to 3 over the long term, or even 2 to 3/4, is still significant and not priced in, and has very meaningful implications for prices across markets.
So just for those who are watching or saying, okay, I hear all of this, what am I supposed to do about it?
Yeah. So I think we are seeing resilience to earnings, which is a welcome development, and it's important to see if it's going to be shared by the technology sector that's kind of led, but we're definitely seeing it elsewhere in the equity market, which is really a constructive development. And I think really the dilemma is for bond investors, because bond investors have been trying to extend maturities, extend duration, right, move out on the yield curve with the hope that that long rate is going to fall and generate returns. And that's been absolutely not the trade. And so our view remains that there's so much more uncertainty now around whether that long-term rate falls, even in the event of the cut. Stay shorter, clip that 5% at the 2-year, nothing wrong with that, and look for brush fires that will come up as the higher for longer world is going to start impacting some lower rated credit balance sheets that are definitely going to start struggling.
What is the unemployment rate if the Fed gets to 2 on inflation?
It would be very significant, and I think that's one of the hurdles, frankly, to the Fed executing
6%?
the kind of aggressive policy that would get us
6% unemployment?
It's been said that it would be between 6 and 7%.
6 and 7.
Yes.
To get to 2.
And that, I guess that becomes the question. Can anybody take the short-term pain to figure out what the long-term implications are going to be until the long-term implications are right here and in front of us?
Correct. But also, they didn't need to loosen financial conditions so dramatically late last year to restoke, this sort of inflationary bid. And now here we are, and they may have to take
No one's going to let that
aggressive
happen in an election year, Oksana.
And that's really a very important point, because now that the possibility of a June cut is kind of off the table, they're not going to move. In the absence of something very, very dramatic happening, they're not moving around the election. And so our next point of action is likely December, and it's really hard to say whether that's going to be a cut.
Oksana, thank you.